This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the weekend edition of Bloomberg Business Week. Yeah, a lot coming at investors in a holiday-shortened trading week. No trading, just a reminder, in the U.S. on Thursday because of the Juneteenth holiday.
Still, a lot coming at us again, including the escalating conflict between Israel and Iran, the fourth Fed decision of the year, and a G7 meeting of global leaders.
Yeah, that is our macro. Our guest this week, the CEO of the publicly held ConnectOne Bank Corp, on the Fed, business environment, and consumer credit.
Speaking of consumers, Dana Telsey knows retail like no other. So is she concerned about this week's retail sales data that dropped for a second month and was the largest decline since the start of the year? It's a question we'll pose to her.
We do indeed. And we've got a global view on tariffs and trade and President Trump with the head of Ireland's Foreign Direct Investment Agency. That's one reaction. We get another reaction from the CEO of Synergy Maritime and United Maritime. And then in our next hour, the CEO of Axiom Space on building era-defining space infrastructure. And wine from Uruguay. It's really good.
And Carol knows it's really good because she tried it.
I did.
Okay. All that to come. We begin with a read on the U.S. economy, banking, especially regional banking. Just before this week's Fed decision, we caught up with Frank Sorrentino, chairman and CEO at the publicly held New Jersey-based community bank ConnectOne Bank Corp, which is the parent company of ConnectOne Bank.
That's right. ConnectOne Bank counts small businesses and construction companies among its customers. The bank recently merged with First of Long Island Corp, which brings its total assets to about $14 billion. CEO Frank Sorrentino kicked off our conversation about why he's optimistic, still optimistic, about this U.S. economy.
Yeah, it's interesting. If you go back a couple of months to Liberation Day and you took a nap on that day and woke up today, you'd say, well, I don't know, things don't look too bad other than what's going on overseas. The market has pretty much rebounded or recovered most of the ground. People feel the economy is on more sturdy ground today than they thought in those weeks after that news. But the economy still is quite robust in the markets that we serve. As you know, ConnectOne is in the New York metro market, in New Jersey, New York, now Long Island, in a pretty big way. And the vast majority of the client base that we have is still seeing strong demand for products and services, a lot of service-oriented businesses. There's still an enormous amount of demand for housing, for apartments, for all types of construction, warehousing. Even office, which has, as you know, been, the subject of, a lot of conversation over the last two or 3 years or so, is seeing a tremendous rebound as we're moving, through this period of time.
I'm getting a few questions from a loyal listener, Ryan Horan, reaching out over the Instant Bloomberg. He's glad we're talking to you because it's a great check of small business and the consumer. He's curious about any worrying trends or any pullback in underwriting that you're seeing. Are you adding to reserves to shield any non-performing loans?
Most banks are reporting that they're seeing a fairly benign credit perspective out there. I know there was a lot of tariff talk 60 days or so ago, and a lot of investors were very concerned about how tariffs may impact bank earnings, through the credit cycle, through any sort of credit cycle. That's really quite diminished recently in the past few days or weeks. And banks are still reporting a fairly benign credit period. There are certainly one-offs, as we would always expect there to be, and there's appropriate reserving going on at most banks. But there's nothing systematic that's out there that where banks are feeling that there are particular segments of the market that are showing more signs of weakness than normal.
Why is that? Not to be negative, but I'm just curious. Why do you think things are holding up?
I always start with, we have a 4% unemployment rate. Everyone has a job, and anyone who's looking for a job can get a job. And so things are good. People are getting raises. There's, plenty of opportunity in the market. There's been an enormous amount of liquidity put in the market over the last dozen years or so that is just driving our economy to all-time highs. The market is reacting to that. You can't buy a car. People are waiting in line for homes and apartments. Luxury goods are on fire. You go to the airport. You can't get on a plane. It's the economy. I keep saying the economy is robust, and everyone keeps challenging me why I use that word. Well, it just is. And so all of these things are driving. GDP is growing at over 3.5%. That's what's driving what's going on, notwithstanding all the news that you're hearing about, a lot of global issues and other, political, craziness that's going on in the marketplace.
But what do you make? We talked the retail sector earlier with Dana Telsey, and we talked about everyone trading down. So you're seeing discount retail doing better than most. Airlines pulling guidance. It feels like there's stuff brewing. And I think it's safe to say that employers are really gun shy about letting go of workers. There is some labor hoarding going on because they remember all too well, Frank, what happened after COVID and nobody could find workers, right? So I just wonder if you've seen a lot of economies. I know I ask you this all the time, but I just do wonder, are you hearing anything anecdotally where people are like, yeah, we're a little nervous. And, if these tariffs are more onerous. Yeah.
I think we are seeing consumers being a bit more price sensitive. Mm-hmm. And I think they are, maybe not spending as lavishly as they might have in the past. And they got a little shook up with the tariffs, and they're looking at some specific products that, may have changed in price. There's been some hoarding going on that I do think impacted some of that consumer spending. I know for a fact that's impacted, building supplies and building goods. People front loaded buying things in anticipation of the tariffs. So there's a lot of turbulence going on in the marketplace today. My read, however, is though, if you strip out, some of the, gas and tariff related items out of the consumer spending, you'll actually see numbers were actually up a bit, not down. And even what they're reporting that the consumer spending was down a bit, it's down less than 1% or point something percent. So it's not a sea change that's going on. There is, some volatility here, but overall, I do not see a recession, and I still see a fairly robust economy ahead.
We're talking to you on Tuesday, June 17th, the day before we hear from Fed Chair Jay Powell. We don't know what he's going to say. I think I know what he's going to say to when he answers some questions specifically about politics and his own future, because he said those same answers for months. But Frank, I'm curious what you see as the path of the Federal Reserve for the remainder of the year. Give us your dot plot.
Well, based on what I just said to you, if that in fact is what's going on in the economy, then the expectation has to be that the Fed does not lower rates because the economy is still quite strong. And so my belief would be that you will definitely see some commentary about the uncertainty that lies in the marketplace as we move forward. There are lots of things to be uncertain about, tariffs being one, the war in the Middle East, the war in Ukraine, and how those things are impacting, gasoline prices, which happen to be down, but could rise dramatically depending on where things go. So there's going to be a lot of things that are inputs that the Fed will be looking at that will determine what's going to happen in the future, and they may give some guidance about what they think those things would be going forward. The market expects the Fed to cut at least one, if not two times this year. I believe it'll be closer to one, and be careful what you wish for. I do believe that, again, this economy will continue to roll on, and the Fed is going to have a tough time to lower interest rates as we move through the cycle.
Frank, I do wonder, too, this was an interesting past earnings cycle where we actually did have folks give you two scenarios, like if everything's good, here's what our numbers will be. If they're not, here's where they will be, and quite a range. And I'm not saying everybody did that, but it was just for those of us who have covered publicly held companies for a long time and the earnings season. I don't remember people doing that. I've seen people pulling guidance a lot, but not giving scenarios. How many I'm curious about the conversations you have with your team. Do you talk about a lot of different scenarios in this environment because it could go a lot of different ways, or no, you feel much more confident to say this is probably the course and here's why we can make decisions based on this course?
We definitely have those discussions. We're definitely keeping our ear close to what's happening. And the thing that I constantly bring back to the table is let's listen to what our clients are telling us. And so, it's one thing for us to predict what we think is going to happen based on facts, figures, whatever, but hearing in from our clients and what they're experiencing in each of the various segments that we do business with, to me, is much more important than any view we may have on our own. So we're still hearing that folks in general are in good shape. There's a fair amount of liquidity still in, folks' checking accounts, and their ability to borrow still remains strong. And so we continue to see a fairly robust economy going forward, and that's what we're modeling for, and that's what we're predicting for the future.
Some people say uncertainty. Frank's word is robust. That's the word he uses, and he's used over and over again.
You've been consistent. You've been consistent, and
uncertainty is a challenge, though, and it is impacting people's decision-making ability. And so, one of the things that I always look at and always counsel people is, hey, look at what's really going on the ground.
Right.
And, try not to get caught up in all the headlines of, what may be going on around you that doesn't necessarily impact you. I've had conversations with clients who are talking to me about tariffs, and tariffs don't actually impact their business.
Right.
So, I'm saying, well, okay, why are we focused on that? So uncertainty absolutely can change the direction of the economy.
That was Frank Sorrentino, chairman and CEO at the publicly held New Jersey-based community bank, ConnectOne Bancorp.
You're listening to Bloomberg Businessweek. Coming up, banking, a great way to get a read on what's going on right now. So too is the good old U.S. consumer.
Dana Telsey is up next on retail.
Expectations are second half of July into back to school is when you'll see the price upticks. And when you speak to companies, it'll more be on some of the goods that are newer and have more product or make or embellishment in them. Essentials are going to be watched very carefully. The phrasing is surgical and select items where there are price increases. That's where it will happen. It won't be across everything.
This is Bloomberg.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
U.S. monetary policymakers voted unanimously to hold U.S. interest rates steady for a fourth straight meeting this past week on Wednesday as they await clarity on whether tariffs will leave a one-time or more lasting mark on inflation. Fed Chair Jay Powell said it's still unclear how much of the bill will fall on the shoulders of U.S. consumers, but he expects to learn more about tariffs this summer.
The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
After the Powell News Conference, we caught up with Ross Mayfield, investment strategist at Baird Private Wealth Management, and Bloomberg Intelligence chief U.S. rate strategist Ira Jersey. Ira put the decision in some context for us.
Yeah, I think there's some people who think that, firstly, that the Federal Reserve does have to cut interest rates because they see cracks in certain parts of the economy. And then there's other people who are fearful of tariffs and think that, inflation might increase. And, this was as I expected. And what's always interesting about this, we have to, as market professionals, kind of parse every single thing coming out of the Federal Reserve. Is the reaction function, right? What is the Fed's reaction function? So we heard a number of if-then statements from Chair Powell, and those if-and statements could mean, give us at least a little bit of an indication of under what circumstances they'll make any kind of policy adjustments.
Hey, Ross, come on in here and just give us your general overview of how the meeting went, your expectations, were they met, were they not met? What was your big takeaway?
Yeah, I think they were largely met. I mean, I don't know anyone who expected much action at this meeting or a resolution of all the uncertainty that they've been discussing at this meeting, given that we're still in this kind of tariff pause We have the potential for oil prices to swing and impact headline inflation. So I didn't expect much. I'm on the side of the camp that thinks the Fed should be a little more aggressive in cutting. I think the cracks in the labor market are starting to really accumulate. And to hear Fed Chair Powell say that the labor market is, I forget the exact language, but on solid footing.
Yeah, he wouldn't agree with you, I think, Ross, that the cracks are starting to appear. What data are you paying attention to that he's not?
Yeah, certainly the anecdotal evidence of layoffs is rising. But if you look at something like WARN notices or initial claims and continued claims, I mean, we're sitting at multi-year highs for a lot of those levels. If you look at some of the employment statistics about people fresh into the job force out of college, the unemployment rate there is at not record highs by any means, but is significantly higher than the overall unemployment rate. So I think it's a labor market where we have tight supply, and especially in this, given the immigration policy, but it is not a robust labor market, and we are well north of a neutral policy. I think that getting to neutral should be more of a goal for the Fed, who doesn't seem to want to get there until the end of 2026 if you look at the SEP.
All right, come on in, Ira.
Yeah, so I just want to say I think that's part of this debate. Like, where is neutral? And there's the Fed will say that it still have restrictive policy, but a lot of the other information that some of us, me included, have looked at suggests that actually they're probably pretty close to neutral. So unless there's a deceleration of the economy, the Fed probably doesn't have to adjust interest rates. Now, the question is, and to Ross's point, like, they can't wait until the economy is clearly really bad before they cut interest rates. But I do suspect that because of this overhang of inflation and the recent past episode that we just had, that the Fed will try to wait until almost the last minute. And then once it cuts, it'll cut faster. And I go back to the statement that Jay Powell made in May at the press conference, where he said, like, look, we know how to deal with a weak economy. We could just cut more aggressively and get down below the neutral rate to stimulate the economy. We don't want to have to go the other way and have to hike interest rates if inflation were to remain relatively high.
Hey, Ira, a couple more to you, and then we're going to bring Ross back in here. But I'm wondering about a couple of things here. One specifically is the question of AI and the labor force. The Fed chair was asked about that. Carol and I cannot stop talking about this.
No.
What did you make of the way that he answered this question about AI and the effect on the labor force?
It feels like there's a pig pile of all of a sudden people are waking up and saying, okay, there's going to be a lot of jobs lost because of AI.
Well, there's always disruptions. Whenever you have new technologies, there's always disruptions, and you wind up having, layoffs in some sectors, and then the new economy creates other jobs and new jobs. We've done that over centuries since, even before the Industrial Revolution. You've always seen, things replacing other things. I mean, we did it 30 years ago, right? When you think about the internet, and in 1995,
right.
Very few firms had websites. Yet today, everyone does, right? And this is kind of an extension of that. So we created a whole new economy around the internet that now is creating more jobs, whereas robotics and other things like manufacturing, less people are needed to do the same amount of work and labor than was needed in 1970s.
That's Bloomberg Intelligence Chief U.S. Rate Strategist Ira Jersey and Ross Mayfield of Baird.
We also got some economic data this past week, specifically U.S. retail sales falling 0.9 of a percentage point in the month of May. That is the largest decline since the start of the year, with 7 of 13 categories posting declines.
We've got a trusted voice on retail, somebody who's analyzed this area through multiple cycles and gets into the details like no one else. The founder, CEO, and Chief Research Officer of Telsey Advisory Group, Dana Telsey, here in our Bloomberg Businessweek studio. I want to start with the big picture data, Dana, the data that we got earlier today, the largest decline since the start of the year. Obviously, people not buying cars has a lot to do with this, but is it proof that tariffs do affect the way that customers think about buying things?
So a couple things you have. Yes, it was one of the weakest months. You look at cars, which were the real weak link. It's 20% of retail sales. You've seen some of the other data points, whether it's sporting goods, department stores, frankly, did a touch better. I think overall, the pull forward of sales, I think we're seeing some of that. We put out a tracker every Tuesday of 80 items and how the prices have changed. We've done this for 9 weeks now. We're going to continue to do it. We haven't seen much change in prices yet. Expectations are second half of July into back to school is when you'll see the price upticks. And when you speak to companies, it'll more be on some of the goods that are newer and have more product or make or embellishment in them. Essentials are going to be watched very carefully. The phrasing is surgical and select items where there are price increases. That's where it will happen. It won't be across everything. But the mood and the sentiment, look at the numbers you got from the sentiment index. Those are better than expected. A little surprising, given the headwinds that you're seeing in some of the services. The restaurant numbers certainly continue to show a downturn.
So add it up for us. Like, you've seen cycles, you've seen stress points that we have gone through, whether, great financial crisis, COVID, like there's a lot of things. How would you describe the retail environment? And I know it's hard to throw everything in one bucket because there's so many different verticals.
I think right now it's more uncertain. The change that's different this retail environment than others, even luxury has come down. Even your high income spender isn't spending in the same magnitude, and you don't have the flood of tourists that have come to the United States like you had in the past to buy those discretionary items. You're still seeing essentials, grocery. That's where the consumer is spending. They'll spend selectively on some services, but take a look. We've seen airfares. Look at JetBlue today. Talk about reduced demand. So how I add it up is it feels a little bit more uncertain because of the volatility, and it's not complete downtrends across the board. It's very selective. And I think, could it come? Yes. I think it's more, let's go into the summer, through the second half of the summer, and see what these price increases are. But there's more concern over slowing than growing.
It's interesting that you brought in tourism here, especially when it comes to retail. I'm wondering on the other side of things. We've heard from executives at companies, including Coca-Cola, that the crackdown on immigration is actually affecting their sales. I'm wondering, from a retail environment, is the ICE crackdown on undocumented immigrants weighing on sales for any retailers out there at this point? People being afraid to shop, people afraid to go out, that sort of thing.
And you think about it for restaurants, in terms of the workers working in restaurants, you've certainly seen at some of the low end points and the retailers. It's interesting that the dollar stores performed okay. So that's where you would think it would show up, but it hasn't shown up there as much. And also you look at Walmart. Walmart's sales were better than expected.
So we are seeing, I hate to say trading down. I feel so not nice, but I just feel like maybe just people are being smart, right? And looking for the best bargain.
They are trading down. Look where Walmart has talked about their biggest growth coming from is their highest income consumer. You've seen it from others. Look at TJ Maxx on the off-price side. You've seen what they have, and they're an umbrella for pricing. So they'll always be lower than everyone else. And I think they're going to be a beneficiary as we go through the back half of the year.
When you and I spoke earlier this spring, you mentioned that we could be seeing some empty shelves later this year. Has that materialized in anything that you cover? And is that still a possibility?
It's a possibility. It hasn't materialized yet, because the goods that are on the shelves right now, there's still some of the lower cost goods. Ordering for holiday is happening right now. And it would show up, frankly, first when you get to the holiday season. But you know what? You have TJX buyers overseas in China right now looking to take over and take control of and acquire those canceled items. So go to the off-pricers.
Yeah, kind of fascinating. Well, and I just wonder, ultimately in terms of supply chains, right? We talk about so much of that because of the tariffs. Dana, when you think about, clothes and things like that, I mean, it's already been moving away from China, correct? Like, give me some perspective on where all of the stuff that we are wearing, where it really is manufactured.
So where things are coming from, yes, they've all looked to reduce their exposure to China. Vietnam has been very popular. Mexico, Cambodia, Brazil. Hard to come back into North America and the U.S. given the high labor costs. But it's been Mexico, it's been Vietnam, it's been Brazil and Cambodia that we hear goods are going towards.
How much is still made in China?
Depends on which type of retailer. Everyone is trying to get to single digits. No one wants to stick there at double digits.
Was that happening ahead of?
It's been happening since the last time we had tariffs. Everyone had accelerated it.
Okay.
But keep in mind, one of the beneficiaries of China, labor costs are compelling, and the make that they put into the product and the expertise is faster and better than others. As a longtime sourcing executive always tells me, there's no China like China.
Wow. Okay.
But it seems like, Dana, at least for President Trump, it doesn't matter if it's made in China or it's made in Vietnam. If it's not made in the U.S., it's going to be hit with a tariff.
Yes.
So how are retailers dealing with that?
They'll raise prices on some selective goods, and it's a third, a third, a third. A third, they'll diversify their sourcing. A third, they'll share the cost with the manufacturer. And a third, they'll raise prices on select goods to the end consumer.
When you say select goods, do you mean, obviously we can't put them all in the same bucket?
Higher price goods.
Higher price goods because the consumer has a higher willingness to pay?
And
there's
because
more
it's
room?
new and different, it's something that isn't a basic.
Okay.
Which makes me wonder, like, which companies are going to see it hurt in terms of their balance sheets. On that, first quarter retail sales, right? We've seen all these numbers. So which names do you think stand out really as the biggest winners? Which are the biggest losers?
You look at Birkenstock with their closed-toed shoes, very popular, still doing really well. I think that there's definitely some momentum there.
That was Dana Telsey, founder and CEO of the Telsey Advisory Group.
Still ahead on Bloomberg Business Week, global shipping and global leaders on edge in today's uncertain environment. Or are they?
The CEO of Synergy Maritime and the head of Ireland's foreign direct investment arm. They're up next. This is Bloomberg.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
This past week, 2 giant ocean-going tankers collided and caught fire off the coast of the United Arab Emirates near the Strait of Hormuz energy choke point.
Separately, 2 vessels were approached by Iranian boats near the Strait of Hormuz, which is noteworthy during regional tensions. The incidents rattled global oil and shipping markets, with forward freight agreements rallying and oil tanker rates surging more than 50% at one point due to the increased tensions.
The Israel-Iran conflict was definitely on the radar of the global shipping industry. It was really on the mind of all of us. Just ask Stamatis Tsantanis, which we did. He is chairman and chief executive officer of the publicly held global shipping company Synergy Maritime.
He's also CEO of United Maritime. United was spun off from Synergy back in 2022. We talked with him early in the week, and he explained how geopolitical uncertainty is forcing him to adjust shipping routes.
I mean, we were going through the Red Sea all the time, connecting, let's say, Australia to Europe and all that. Now we have to go around the Cape of Good Hope, so that has added a lot to the ton-mile effect. And of course, the pollution, because you do more miles, you emit more CO2s. It's more expensive for the consumers. You go a longer distance. So the answer is yes. I mean, every little thing that happens, or bigger thing, it's good for rates, but bad for the earth, I guess.
Do you see it getting worse in the Strait of Hormuz anytime in the near future? I know you said you're optimistic, and you're optimistic by nature, but that's a real energy choke point, as Carol mentioned.
I want to believe that there's nothing serious is going to happen, and the collision you had today is not actually a product of war.
Correct.
It's the shadow fleet. The shadow fleet has been going around since the Russian invasion, and you have all these undocumented and shadow ships going around, and there's like a danger. And it's only a miracle that we haven't seen more of these things happening because of the shadow fleet.
Forgive me.
Yeah, that's a product of the previous war, not like this war.
Well, how do you, as someone, right, who's got to watch these things so closely, determine or think about, okay, this is not such a big issue, this could be something more substantial?
Well, we try to be prepared. I mean, except for the insurance and stuff, whenever we see any conflict arising, we don't want to put a health risk of our crews, of our people, so we just stay out of that. And we're lucky to have partnered with some of the world's biggest charterers, and whenever we tell them that we want to avoid war areas, they listen to us, so they're not going to push us to go through the war areas.
What tools do you have on ships to prevent from pirate attacks or defend from pirate attacks?
If anyone says that they have sophisticated tools avoiding that, they're lying. Because, we just avoid these areas, and whenever we have to cross pirate areas, we always have armed guards on board the ships. Otherwise,
there's no other way to do it.
No other way to do it. I mean, whoever says that, these are commercial ships, slow-going commercial ships.
Easy targets, in other words.
Easy targets, yes. Yeah. So you just avoid it altogether. That's
super big, but slow and move, right?
Super big, yes.
Hey, one thing I want to ask you, what's great is Tim and I love to watch money flows, right?
Yeah.
Money tells you so much, but I also love to watch when it comes to transportation. Transportation flows tells us a lot about what's going on in the world. The U.S. more protectionist policies, how has that impacted global dry bulk demand? What are you seeing in that regard?
Well, I'm sure it is for the right reason, eventually. But so far, it has created a lot of uncertainty. A lot of people are just don't know what to do. I mean, imports in the United States have really dropped significantly in the last few months because of the potential tariffs that I don't even know if they have kicked in or not kicked in already. So we need certainty, and we need to make sure that people will be able to trade always for the benefit of the U.S. consumer and always for the benefit of everybody. But it really has to be like a dependable and, to know what you expect. That's the thing.
But are things already changing in terms of flows back to the United States? We have seen changes, right, already?
Indeed, yes. I mean, what we do, which is iron ore, coal, and bauxite, doesn't really change. It's still super strong, the demand for these raw materials, because you need it for infrastructure. As you know, a lot of investors, including a lot of people here in the government, have invested significantly in infrastructure in the Middle East. You have $1.6 trillion of investments happening there, new nice buildings and all that. So this is going to happen. They're all fully funded, and it's good for our business, I guess.
On the protectionist policies, I'm wondering what you're seeing in terms of goods flowing to and from China, and specifically if China is looking elsewhere for commodities that are typically sourced from the U.S. I mean, we could talk grains, we could talk corn, soybean, wheat, and the like, or we could talk other commodities too. What are you seeing?
Well, suddenly the last few weeks, we saw a surge in exports from the U.S. Gulf, the American Gulf. So we see a surge in
yes.
we see a surge
the Gulf
of,
of America.
Yes,
okay.
Exactly.
Well, I just wanted to hear what you said.
So
okay.
we see a surge in corn products, maize, grains, and all that. So that has been good, actually. We were not expecting that, and we came into
this. But coming from the U.S. specifically?
Yes.
Okay.
And we do a lot of coal out of Baltimore.
And going where?
To India and in China as well. We see that picking up slowly.
It did slow down.
It did slow down a lot, yeah. But now it's picking up again. I don't know if it's going to be there to stay, but for the time being, it's going quite well the last few weeks. Let's hope it's going to remain. And we do a lot of coal trades out of India Baltimore to India. So we've done a couple of trades recently, which we hadn't done for a while.
So in terms of any of the flows that have shifted, is it just, in your view, kind of defensive maneuvers and just a result of maybe short-term blips, and you think things are going to go back to the way it is? Or do you see some new long-term trade flows based on the shipping demand?
Well, China's reliance to the U.S. grains has dropped a lot. I mean, they learned their lesson in the previous administration, not the immediate previous, but the previous before that.
Mm-hmm. Yeah.
And they have now they're more dependent now in South American crops. So that's the crops. So that's the thing. If it ever gets back to importing more and more grain products from the U.S., I hope it does, but it doesn't really seem like that in the near future.
Before we let you go, just 30 seconds. I think right now there's a focus on where ships are built that hasn't been in focus really ever in my career, specifically Chinese-built ships. Are there any Chinese-built ships in your fleet?
In our fleet, out of the 29, we only have one, which is basically a Japanese yard based in China. So I don't know if that qualifies for Chinese altogether. But the vast majority is
made in China.
Yes, made in China, but not really by a Chinese yard. So no Chinese interest. So I'm not concerned about us. The only good thing I need to say is we've been in discussions with the U.S. administration about that issue, and they're listening. They're positive and they're listening. They want to find a solution. So they're not like totally black or white.
That was Stamatis Tsantanis, chairman and CEO of the global shipping company Synergy.
Geopolitics, a major theme of this past week, with G7 global leaders gathering in Canada to talk wars, conflicts, trade, tariffs, and a lot more.
Another global voice to put it all in context for us. Michael Lowen, CEO of IDA Ireland. It's the foreign direct investment agency of the Irish government.
When we last met, actually, just in March of this year, I think we've gone through a lot in those intervening weeks, to be honest. Probably as much as I've seen in my career in foreign direct investment, a lot has happened in a very short space of time. And when you think about from the tariffs in terms of what tariffs means, where they're going to be imposed, at what level, in what time frame, a lot of those questions still remain unanswered as we sit today. And I think from a European perspective, we are very clear that, bringing negotiation, trying to get to a point of I suppose, consensus around what this looks like. It's so critically important for investment flows and indeed for the economic prosperity of the world, whether it's the US or whether it's Europe or indeed whether it's Asia. So that's a real area of focus from a European perspective and indeed the Irish government perspective. And of course, you're correct. this is all against the backdrop then of some other conflicts across the world, and you know, we see that increasing. So, you know, we're very mindful of that in the context of trade flows and trade investments as well, because that brings another level of uncertainty into the equation. Yeah.
It's been pretty much exactly 3 months since we last saw you. You were here in New York right before you went to Washington with the Prime Minister to visit the White House.
That's correct.
You met with the president. You met with his team. How did the meeting go?
So you're correct. The last time I was here, I left and I went to D.C. with An Taoiseach, our Prime Minister. The meeting went very well, actually, and I think actually it was in reflecting on it, you'd say that, you know, the president was actually very gracious in terms of his engagement. Yes, there was forthright discussions, and you know, he talked about the challenges in terms of trade deficit in particular.
This was before all the tariffs were announced.
Yeah, this was before, but remember, this was all very, you know, it was all very live and active at that point, because we were talking about, this is the 15th, 16th of March, so it was all becoming very transparent or apparent as to what was going to come down the tracks. So I would say that meeting and engagement very much reflected the relationship, which is 100 years between Ireland and the US. And I think in any relationship, there can be points of let's call it discussion. And that was a discussion that we had, but I would think it was very respectful on both sides.
Michael, what changes have you guys seen in investment flows? What are you seeing from your vantage point?
Yeah, so what we're seeing today, actually, Carol, it's interesting. So I can sit here today, and actually in 2 weeks' time, I'll be sharing with our Minister, Peter Burke, our results for the first half of the year. And while I can't disclose them to you on air, well, I could, yeah, but I won't. But what I can say is that we continue to see investment flows. In fact, it is a par with last year in terms of the first half of last year, which is maybe surprising given the level of uncertainty that you see across the globe. But the reasons we see that is, and we're seeing across a number of different areas, we're seeing real investment in research and innovation continuing, and companies looking to double down on their investments in Ireland in innovation. We're also seeing a lot of investment as well in terms of new entrants into the Irish economy, which is really important. And that's because they're looking for global marketplace, stable locations which is trusted and proven, I believe, and that's what they're seeing in Ireland in terms of the future growth.
I know you can't reveal all, but I am curious. So on that, where there's new investments coming in, are there conversations you're having with entities, global companies, U.S. companies who say, we want to do more stuff with you guys because we don't necessarily want to be in the U.S. or other, give me an idea if there's anything that's a repercussion or, you know, the result of an action by the White House.
Yeah, so I don't think it's a scenario of we don't want to do it in location A, so we're doing location B. I actually think companies are looking to actually, how can we grow our business? Where can we grow that from? What markets do we want to serve? And where can we get the skills or the policies that support that? That's really what we're seeing. And what we do in Ireland is that, you know, we make sure we bring stability and certainty to those areas of policy in terms of talent and talent availability, not just Irish talent, but international talent. These are the pieces that are setting, I believe, investors apart when they're looking at locations around the globe. Because I said previously, at the very core of FDI and of multinational companies, they look to international markets. They need international markets. They need international supply chains. They need international talent. That's what they need in order to be successful. And that success isn't just success in the country they're located in. It actually comes back to their entire supply chain.
That was Michael Lowen, CEO of IDA Ireland. It's the foreign direct investment agency of the Irish government.
And that wraps up the first hour of the weekend edition of Bloomberg Businessweek from Bloomberg Radio. Ahead in our next hour, sending everyone someday into space with the CEO of Axiom Space.
Plus, Meta paying billions to tap into Scale AI's intelligence.
And experiencing wine in Uruguay. This is Bloomberg Businessweek. I'm Carol Massar.
And I'm Tim Stenovec. Stay with us. Today's top stories and global business headlines are coming up right now.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
Plenty ahead in our second hour of the weekend edition of Bloomberg Business Week, including AI for commerce and retail and building the next generation space economy. We'll talk about that with the CEO of Axiom Space.
Plus, Meta gets out its checkbook to catch up in the AI race, and the little Tuscany in Uruguay with Christian Wiley of Bodega Garzon.
First up this hour, a little bit of AI news this past week. Elon Musk's AI startup XAI is burning through $1 billion a month, with expected losses of $13 billion this year due to the high cost of building advanced AI models. Now, to cover the gap, XAI is trying to raise $9.3 billion in debt and equity, with plans to spend over half of it in the next 3 months and expects to be profitable by 2027.
That is a lot of cash burning. Certainly the big spend is on. And we recently caught up with one part on the AI spectrum, and that is the AI that customers deal with. That's where Daniel Wagner comes in. He's chairman and CEO of Resolve AI. Resolve is a suite of AI-powered products. It's meant to help companies with customer retention, engagement, loyalty, and support.
It is nice to have you here with us. Tell us a bit more about your company and the environment right now.
Sure. So, I'm a multi-decade entrepreneur in the tech business, and Resolve AI is the culmination of my career in many respects, having built market leaders in e-commerce and search. The development of Gen AI as a technology is an enabler, and we use it to really enhance the digital experience for consumers. Right now, when you go onto an e-commerce site, it's a very perfunctory experience, and it's actually very ineffectual because 7 out of 10 people who go into a physical store end up buying a product, and 7 out of 10 people who go into a digital store end up not buying a product. And the reason for that is because I believe they don't get the answers to their questions that they need. If my wife wanted to go and buy me a mobile phone, she couldn't do it online because she doesn't know what iOS is or Android. She doesn't know what a megabyte is or a megapixel. But if she went into the AT&T store on Lexington Avenue, the salesman would help her through that process.
Right.
So what we're doing with Gen AI is we're changing, e-commerce into a conversational commerce. We've created a language model that is the best salesman on the planet with deep product knowledge, empathy, and sales techniques.
So with your wife, what might it do with her, where you say she doesn't have this?
So she would go to
I'm in that camp too, which is why my husband buys all of our phones. But I'm just saying, how would that help her?
So she would be able to go to a website now and say, hey, I need to buy my husband a mobile phone. What would you recommend? And the answer would be verbally or typed up on the screen.
Right.
Well, tell me a little bit more about your husband. Does he use a PC or a Mac? Is he a business person or a creative? Does he use his phone all day? Or, and the answers to those questions will guide her to a phone with a long-lasting battery or a phone with, an Android or an iOS. And she would result probably with buying a phone from that digital site.
Do you use your own LLM that you've trained yourself,
Yes.
or are you using a Claude or an OpenAI?
No, we started
ChatGPT?
developing this in 2016.
Okay.
So a lot before it became fashionable. I come from as information services and, as I mentioned before, commerce and retail. So we understood about data structure. We understood the implications of the algorithms, the foundational algorithms for Gen AI. So we started building a language model initially that could replicate the best salesman on the planet. And then we built products that sit on top of it that allow our customers to deploy it really as a plug-in to their existing sites. So it's a very easy deployment for our customers.
But if it's a plug-in, then how does it know if you're shopping? How is it an expert in shoes and running shoes, for example, versus an expert in phones?
So think about our LLM as a sort of blank sheet of paper. When we approach a customer, it doesn't have the world's knowledge. Right. It just has conversational skills. And then what we do is we import the product catalog of that retailer. So it could be shoes or whatever. Then there would be context around that. So
you still have to train after a company signs
not really,
up for
you just
your
ingest.
service.
No, it's not really training. You ingest. We've already trained the model to be a salesman. The training, quote unquote, of its product catalog is literally a matter of minutes, probably hours at most. And then everything else about the language model and the technology is that it is a very proficient salesperson. So if you take a physical...
So it's all digital information. You just basically put it all in, right?
Let's just take a physical analogy, okay? If I'm running a camera store and I need a new sales guy or girl joins my retail store, the first thing I'm going to do is say, hey, here's our products. You better learn about the products. Do you know anything about photography?
Right.
So that the next time somebody walks in, they can sell a camera. Now, we're able to do that piece in a matter of minutes. And then from that point forward, all of the best sales capabilities are inherently built into our model.
Where did you train it?
Where did we train it?
Yeah. What information do you use to train?
We use the Canadian book repository, which is 200 million books, open source books. And we use Wikipedia for language and context.
Okay.
And then, so it has 300 billion token data sets as the foundational model to it. We did this over a period of years. So unlike many others, we didn't throw bucket loads of cash, into a big black hole. We trained it over a period using a much more efficient model. And so it took us, 6 or 7 years. But then we ended up with the foundational model that has been recognized by Microsoft and Google, who are partnered with us, as one of the leaders in the field. One
of the examples you use on your website is saying you're having a dinner party, you want it vegetarian, you have 6 people coming.
Yeah.
More or less. Give me some recipes or what should I make? I could use ChatGPT for that right now.
But
why is this better?
You couldn't do it on D'Agostino's website or on, Target. So we're selling to retailers. We're not providing, Google. We're providing Best Buy.
But is it a huge... Go ahead.
So in other words, if your wife was looking for a phone, she would go to, let's say, Apple.
Well, she'd go to Google. She'd go to Google, search it, and end up probably on AT&T side or Verizon or something like that.
But with yours, she's got to either start with Verizon or start with Apple or Samsung or something, right?
No, not necessarily. I mean,
because how do you compare? Like, how do you get the
You got to remember, right? There are millions of retailers out there who are driving traffic to their sites all the time. When you get to that site, 7 out of 10 people drop out. So what we're doing is that when you arrive at that site, you're welcomed. You get answers to your questions. You get detailed information about the products you're looking at,
right?
So that you're guided through the sales process. So if I went to Macy's today and I said, hey, I got to buy a gift for my niece for her 21st birthday, it's not going to give me an answer. I'm going to have to navigate through lots of categories and try and figure out, do I want to get her a candle? Do I want to get her, I don't know. But if I was to be able to ask that question of the salesperson in Macy's, they say, hey, we've got lots of ideas for you.
Right.
So there'd be
what is she like?
We're leveling up commerce from what was a poor experience to a very rich, engaging experience, which we believe and have shown results in better conversion, which has a material impact.
What's the change in the conversion?
Well, it's only been going a short period of time, but we announced only a few weeks ago that we've seen 25% uplift in conversion, which is massive. Massive.
What's to stop a company like ChatGPT from just selling directly to Target or D'Agostino and saying, "Hey, this is what's going to power it.
Yeah.
Come to us because we have this data set."
So they're a generalist, right? So the issue with that is that they already think they know everything, and that contaminates the model. Okay, so if you ingest a whole load of cosmetics and fragrances, they're going to have names like Savage and Beast, and their descriptions are going to be things like blackberry notes with sandalwood and barbecue, right? Now, a Gen AI model, like OpenAI, doesn't understand that and will hallucinate thinking you're talking about a beast in the wood. We have a clean slate. We're ingesting fragrances. We tell the model, it's just fragrances you're ingesting, and then it knows how to sell that. So it's a different approach, and it's why Microsoft and Google partner with us, because they recognize, both of them with significant investments in AI, recognize that we have really focused on this vertical to make this the most appropriate solution.
Well, it sounds like each one, because you're dealing with a particular retailer, it's their kind of closed data set.
In some respect, it is.
Right?
Yeah.
And so you just kind of whittle it down. All right. I pull up the FA function. I know you're a young company. You just started. So what are your expectations in terms of revenue growth? Like, where do you see this company
we're
going?
hitting it out the park straight away.
What kind of growth are you seeing?
Well, we started at the beginning last year.
I mean, it's easy to ramp up.
Last year we had nothing. Beginning of this year, we announced a couple of weeks ago, 41 million consumers have our technology on their phones. I mean, it's like almost instant. We're going to exit this year with $100 million of ARR, and we signed a deal only 2 or 3 weeks ago in partnership with Google, which was a $10 million annual deal with Liverpool in Mexico, a very large department store.
What is that partnership with Google? Because that's fascinating, right? They're doing their own thing. They're worried about potentially being replaced in terms of a search engine, which is why they're doing Gemini, but they're watching very carefully, right?
Yes.
In terms of how people are now communicating online.
Both
to find
Microsoft
things.
and Google both wanted to do an exclusive deal with me. I rejected both of those advances, and we ended up doing a non-exclusive deal with both. It demonstrates our position in the market and the valuable asset that we have in this vertical. Google.
So what's the deal with them? Tell me how that works.
So Google are introducing our technology to their retail customers as a solution, which ties in those customers to Google Cloud and to us. So they see us as a sticky enhancement to Google Cloud. Microsoft are doing exactly the same thing and see us as a sticky enhancement to Azure. Both Azure and Google Cloud are competitive cloud services that are really, you can move from one to the other very easily. But with our technology sort of embedded in those customer accounts, they see us as, retaining those customers when they come up for renewal. And as a result, they're pushing us out to 90% of the retailers on the planet because those two companies basically deal with pretty much everybody.
You've got a few different products in the suite of software as a service products. How do you know that consumers are okay with this at this point?
Well, I think look, I'm an innovator. All the products and services I've created in my career, which have all gone on to become market leaders, have always been very, very innovative. The first company I set up in 1984 was a pioneer in online information. In fact, Mike Bloomberg licensed my content newspapers for the terminals back in 86. So we were pioneering stuff back then. We're pioneering stuff in the late 90s, and we're doing it again now. I started this in 2016. We're 9 years in, and now we're productizing it and going to market. We're way ahead of anybody else in the space. I believe, and I think it's being shown by the take-up we're seeing in the last few months, that we're onto a winner. This is a step up for commerce. And right now, I believe the environments and the interfaces that we're using in commerce are so out of date, they're 40 years old, that they're due a complete refresh.
Just really quickly, 30 seconds. I haven't heard Amazon. Are you talking with Amazon?
No, obviously, Amazon is the big competitor to every retailer on the planet. They do a great job. We're not going to try and sell to them, and we're certainly not going to be partnering with them. Our customers are everybody else.
That was Daniel Wagner, Chairman and CEO of Resolve AI.
The AI race is on, yes, indeed. So too is the next generation space race.
It's where we go with the CEO of Axiom Space.
No single country, no single company can get off the planet alone. And if you believe we are destined to be off planet, to be multi-planetary, which I do, we have to do it together. So that's what you're seeing. It can't be done alone.
That story is next. You're listening to Bloomberg Business Week. This is Bloomberg.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
Some recent news from the world of space. NASA and Axiom Space postponed the launch of the Axiom Mission 4 to the International Space Station.
Everyone's familiar with NASA, of course, but Axiom Space, perhaps not so much. Axiom is focused on developing private space stations, human spaceflight, spacesuits, and more. Yeah, it's kind of rocket science.
It is indeed. Tejpal Bhatia is CEO of Axiom Space. He stopped by our Bloomberg studio recently.
At Axiom Space, we're developing the products and platforms for humanity to thrive off Earth. And you said you wanted to talk about the macro and how the geopolitical situation right now impacts us. If we were to go a little more macro than that, up to the level of space looking down, space has proven to be the ultimate experiment for international diplomacy through crisis. Right, the International Space Station is a collaboration of 15 nations over the last couple of decades. And over the last few years, access to many more nations thanks to companies like Axiom Space and our public-private partnership with NASA and other companies. What you really see is through the crisis times, what's happening down here is not really what's reflected up there. They're working together to develop this platform and this lab for the future of humanity. And what we see is what's happening down here does impact a lot of decision making, but ultimately up there it is the ultimate collaboration. And if you think about the International Space Station, it's the largest object ever created by humans. It is the most expensive product created by humanity in a time where it wasn't as connected and real time as this. Think about 30 years ago.
Right.
They were doing this across languages, across borders, on phones, in the Soviet Union, in the US, in Europe, in Japan, in Canada, and they got that thing built.
Speaking of collaboration, I'm curious about the recent announcements that Axiom has made with foreign governments. I mean, we're talking Egypt, Czech Republic, Portugal, among others. Perhaps there are some out there who might say that it looks like there could be Axiom being a private sector arm of the State Department, essentially in the sense of boosting soft power globally, sort of as the U.S. has used in the past space diplomacy to compete against China. I'm curious about your take on this. And, if you have any coordination with the State Department or NASA when it comes to these deals.
It's spot on. I wouldn't necessarily say it as a space diplomacy arm of the State Department. What I'd say is what Axiom has proven is commercial companies can drive U.S. diplomatic interests overseas. So we're a private company. We're an American company.
Is this the new soft power?
It is.
Forgive me, and go ahead, please.
And it's exactly what I mean. I would expand that a little bit, also given the light of the news today. It's power. It's hard power, it's soft power, and it's economic power. And what you see is a 8-year-old startup. And you were saying that it's rocket science. I joined the company a little under 4 years ago. I invested.
And you just became CEO.
I just became CEO. I invested in the company about 5 years ago. I don't have a space background besides being fascinated since I was 3 years old, right? I'm not a rocket scientist. I'm not a billionaire. But here, this outsider from the startup world, the tech world, the Google world comes into space and in a very short period of time can have this outsized impact. And what we saw in this last week, I just arrived from Florida. We were down there for our launch.
We're going to talk about that in a minute.
We were at tables and conversations with NASA, SpaceX, the Russians, the Indian Space Agency, the European Space Agency, the Hungarians, and the Polish. This is the future of international collaboration. And right in the center and the front was a startup, an American startup. So being able to drive U.S. diplomatic interests, but also overall diplomatic interests. You mentioned the Chinese. They've had a space station since 2022, fully manned.
Yeah.
We remember the first space race, which was the U.S. versus the Soviet Union. The second space race is China versus the West and its industry. And the third space race is the first to create the next applications that are going to change humanity. So we see this rapidly scaling from 60 years down to 6 years to the next 6 months. I think you're going to see rapid development in space commercialization.
I have to ask you, my father was a rocket scientist and involved in the first space race. So I kind of liked him. Like, we just love this world. But what I'm curious about is it was a race for the United States to succeed before others. And it just, what you are laying out for me is a lot more collaboration between nations and regions of the world, where I feel like our headlines are often showing all of those groups that you were talking about kind of with stress points and tensions. So tell me, I mean, does that really show a much more true picture of what is going on globally in terms of relationships? Help me make sense out of that.
I think it does. And this comes back to your first macro question. And I will start macro, then I'll bring it very micro back to the first space race, the second space race, and what I think is the third space race. The macro point here is a little more philosophical, but it is actually a collaboration question, is no single country, no single company can get off the planet alone. And if you believe we are destined to be off planet, to be multi-planetary, which I do, we have to do it together. So that's what you're seeing. It can't be done alone, despite what you're hearing down here and what you see on Twitter. And these problems are very, very
It's not
real.
a race, though, to be the first nation to do
It's
it?
a different race. So the first space race, getting back to your father's time, was actually a race. 2 countries. It was so hard and expensive and impossible that 2 countries were racing to get the first human, the first astronaut off planet. In those 60 years following that, there was an average of about 8 humans per year that went off planet. In the last 6 years, that average has jumped to 22 people per year. So in just the last 6 years, we've almost tripled the number of people that go up. 16 of those were with Axiom, which is just in the last 3 years.
Can you explain, Taj, exactly where you work within the context of SpaceX? Yes. For example, I think a lot of people are familiar with SpaceX. The launches get so much attention. The Dragon capsule and what it does with the ISS. Just explain where you sit in the ecosystem.
Absolutely. So when we pull these missions together, like the AX4 mission, India, Hungary, Poland through the European Space Agency, Axiom is pulling that mission together. So we are going out, getting the customers, creating the crew, procuring the vehicle, SpaceX being the launch provider, getting the permit from the ISS, primarily NASA.
You guys are essentially the producer.
That's a great way of putting it, actually. I don't think that language would necessarily translate to the space industry. Hollywood and Houston speak very different languages. It's both English, but it's very different languages. Hollywood and
but that sounds like what you're describing to me. You make it happen.
Yeah, and think about when a producer puts together a package, right? That's also a word that probably wouldn't resonate in the space industry. That packaging has a ton of value. Yes, the physical film or theater or studio or camera groups, but think about the intellectual property. Think about the products that are created and the derivatives that create value. So when we pull together these missions, there is a very large element of mission integration, training, payload integration, but the key is locking in the demand. Those countries are trusting us. And these decisions aren't made at a space agency level. Mm-hmm. These are done at the prime minister president level. You're not sending up a human to space with a startup, with an American launch company, without significant consideration and trust.
You mentioned you were just back from Florida, where you were for the AX4 mission launch. It was ultimately scrubbed. When are we going to see a new date? And what exactly have you been told about leakage on the ISS?
Sure. So the mission was scheduled to launch earlier this week. We had some weather delays, which is normal for a lot of our guests who have gone down to Florida and want to see an anticipated launch. While it's normal for the space business, it's not really normal for someone who flew down to Florida to see it, but it happens. I've been through 4 launches myself with Axiom now, and the delays usually go, sometimes months, then weeks, then day by day based on minor things. So we had a weather delay, totally normal. There was some data that came back from the launch vehicle, which was resolved, also completely normal. Sometimes that happens during a test, a readiness review. Sometimes it happens on the launch pad. Better to happen before than on the launch pad, but these are all measures for safety. Then this issue on the ISS, the leaks have been happening for a while. There is an effort to improve it, to fix it. The ISS is old. It's a thing. You can think of it as a piece of equipment, not really like a building. It has a lifespan, which is it's coming to its end. The whole reason Axiom exists is we won an award. We are the exclusive company, the only company that can connect its modules, commercial private modules, to the ISS. The reason for that is to prevent a gap in human presence in low Earth orbit. So Axiom connects what I'd say is a bridge, but it's actually physically a tunnel, onto the ISS. We make sure we preserve whatever assets and value we have on the ISS. We connect our second module, and then we can separate and be a free-flying commercial platform. So with the ISS itself, that's where we go right now. So in this production, imagine this as the studio or where we're going for. So their risk profile and their safety profile is what we follow. But remember, our risk profile is a little different. When NASA sends up astronauts with SpaceX, they're sending U.S. astronauts.
Right.
We are sending other countries' astronauts. So we don't take any risks here.
Since you rely on SpaceX for launching, what happens if Elon Musk has a fallout with President Trump and the U.S. decides to move away from SpaceX? What happens to you?
So what we have right now is what I'd call a supplier-constrained market. And that's okay. There's only one way to go up and down. And what SpaceX has done is phenomenal. And I really hope it doesn't go away, right?
It's important.
It's important. It's very important. What I see from SpaceX's point of view and their mission, I understand. Not the feud that's going on, not the rhetoric, not what's on Twitter.
None of us understand it, to be quite fair.
But I can understand the magnitude of what it takes to get off planet. Now, what they've created from a launch standpoint, it is phenomenal. It's elite. It is, really a wonderful thing for humanity, and I'd hate to see it go away. With that said, in a supplier-constrained market, certain dynamics are created. So to be the other power player, if supply is locked in, you want to lock in demand because that gives you leverage. And we've seen this model. You brought up the producer angle. I got my start at ESPN in media, and we can go back to the 70s and 80s of cable and satellite, how content companies, how Bloomberg TV probably got its opportunity, how ESPN, MTV, CNN, MTV, when there was the cable satellite wars, who benefited the content companies and the consumers. So I believe we're in that kind of market dynamic right now. So our hypothesis really is about the customer demand.
That was Tejpal Bhatia, CEO of Axiom Space.
Still ahead on Bloomberg Business Week, Meta spending mega bucks on Scale AI and tapping into a mega wine experience in Uruguay.
Those stories next. This is Bloomberg.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
Meta Platforms taking a 49% stake in Scale AI with Alexander Wang, who's 28 years old, joining Meta as a top executive to build AI superintelligence.
It's a stake, right?
It's a stake.
It's a stake.
S-T-A-K-E.
Yeah, not something you can
Not
eat.
a steak, an
It's
S-T-E-A-K.
Like a steak you put in the ground. Like,
And Carol, it's not an acquisition.
Yeah.
Okay?
If it walks like an acquisition.
Dave
and
Lee says
sounds like
do
an
not call it an acquisition for a
All
host of
right.
reasons, okay?
Yeah.
Dave Lee is U.S. technology columnist for Bloomberg Opinion. He spent about 15 years reporting on tech at the FT and BBC before joining Bloomberg. He joins us here in the Bloomberg Interactive Brokers studio. Do we just not call this an acquisition? Like, why are we not why are companies not acquiring things right now?
Because they're afraid to. They're afraid that the courts are going to undo their old acquisitions. So at this time, they're thinking probably too risky, too complicated. If the stake was 50% as opposed to 49%, that would, of course, be a takeover rather than an investment. And immediately that would trigger all kinds of reviews. They'd have to wait. They'd have to get clearances not only in the US, but also around the world, different regulators. There's no time for that in the AI era. They've got to get to work straight away. And so we're seeing this sort of new approach, which I sort of likened in a column I wrote to sort of when a football team buys a great young prospect. You know, they pay a transfer fee to compensate wherever he's leaving. In this case, for Wang, it's about, you know, making investors whole at the Scale AI, the company he founded. And they bring on this young talent with the view that he's going to be, you know, he's going to run a super intelligence team at Meta. And this is obviously what Mark Zuckerberg thinks is needed to bring his team up to speed and to compete against the other big teams.
He's going to be sitting by Mark Zuckerberg, reportedly. Mm-hmm. What is superintelligence? What is and also Scale AI is not building its own superintelligence either.
It's a new Avenger.
That's what's confusing to me.
So Scale AI is an interesting company. It's kind of right at the very early stages of AI development. It's about hiring humans to do data labeling and say that's a tree, that's a bus, and so forth.
That doesn't sound like superintelligence to me.
No, but the crucial thing, and a colleague, one of my colleagues, Ellen Hewitt, wrote this fantastic piece about Alexander Wang today, sort of talking about how this guy knows everybody in AI and he knows everything that's going on. And one of the things about Scale AI that makes it particularly useful for Meta is that it's a company that other companies would go to when they needed data. So they were working with OpenAI, they were working with Google, they were working with several other companies. And so they have a bit of an insight into what those companies are working on and what sort of data they were needing to have. So now Mark Zuckerberg gets a bit of that intelligence.
So it's not necessarily we want what you have. We want what you know about what kind of the whole landscape is doing when it comes to AI. What have these companies come to you for?
Yeah, exactly. And also, Alexander Wang is just known as a great networker.
Right.
And so when so much of this AI race is about talent and bringing people on, we're hearing Mark Zuckerberg is emailing people personally and saying, come and join us. I'll give you $10 million if you do it. This is just a signal of how fierce the AI race is.
It's just a different type of signing bonus, right?
Precisely.
That's what it sounds like, right?
Like a sports star, but considerably bigger in terms of the numbers we're talking about.
What's the promise, though? I mean, what is this super intelligence that they're working toward? What is the world, Dave, that Meta Platforms wants to build and be ready for?
I'm not sure I want to imagine it, frankly, but it's
you and me both.
I mean,
man.
Look, there's various names for it now: super intelligence or artificial general intelligence.
Is it fair to say AGI and super intelligence are the same thing?
It's all basically the same goal. This idea that you can create this essentially one machine or one technology that people can use for whatever sort of varied uses they want an AI to do, and there is this feeling that somebody will get there first, right? Now, I'm of the view personally that there'll be several players doing this, and that's how the land's going to turn out. However, I think there is a sort of panic to make sure that we've got to be first or very, very close behind.
To be fair, right, Dave? I mean, Microsoft has done some similar moves, right, to try and position themselves by acquiring, either different people that seem to have certainly some AI insight or know-how. I think Alphabet has done the same thing, right? So they're all kind of jockeying for position.
They're all jockeying for position, and they're also taking the same approach of we can't be seen to be acquiring companies, but we can try and acquire people. Now, I think they're not as clever as they think in this regard. I think the Federal Trade Commission, the Department of Justice, they know what's happening here. They know this is competition just in a different form, because if you've got companies that are spending crazy money on wages, does that mean a smaller company just can't compete for talent? I guess not, right? So there's going to be, and we already know the FTC is looking into some of these deals.
They are
and
already
looking at what they're going to do. Yeah.
What's going on when it comes to innovation at these huge companies? I mean, I read your column and I think to myself, this is turning into like a Pepsi buys Poppy for $2 billion type of thing, because we want to let the startups duke it out for shelf space when it comes to probiotic soda. We're not going to develop it ourselves. Is that happening? I thought the startup ecosystem, I thought there was like, a decade ago, I thought Facebook killed the startup ecosystem.
Well, I mean, look, I guess it's a question of the shifting purpose of the ecosystem to those big companies, right? I mean, it used to be if you started a startup, you had several exit opportunities. You IPO, you get acquired. Both of those channels have almost been closed off. We're not seeing so many tech companies IPO anymore. That's really dried up, and it's becoming much harder for tech companies to acquire companies at all. But at the same time, the startup ecosystem still has this fantastic ability to work quickly and bring out new ideas. And I wrote in that column you referenced that, I'm not sure if Alexander Wang joins Meta as like a junior engineer, I'm not sure he rises through the ranks and becomes this guy. I think that's only something you could do outside of the company. And that's just the nature of startups.
That's Dave Lee, technology columnist for Bloomberg Opinion.
Before we go, how about a journey to a family-owned winery in Uruguay? Since 1999, Bodega Garzón have been making wine and developing a mega wine experience.
Christian Wiley is Bodega Garzón's managing director. He stopped by to tell us all about it.
It is a uncertain times. The tariffs, of course, came on top of a lot of complications into the alcohol wine industry, and you just basically need to keep going. You have a long-term strategy, and the most beautiful thing is that wines just get better with age. So we have to be patient. But it is a challenge right now. It's tough.
When we think about so-called New World wines, I think a lot of people often think of, in South America, maybe Argentina or Chile. Uruguay, not really on the map as a wine destination as much as other areas. Why is that?
Well, I mean, it's not on the map because they've been drinking all their wine they've been making for the last three centuries. But then Garzón comes into play, and this is an incredible investment of Don Alejandro Bulgeroni. It's a $250 million capex. It is the largest investment ever in the industry of wine. And this is right next
in the region or in the world?
Wine
in the world.
Wow.
So this is right next to the beach, to the Uruguayan Riviera. So you have Jose Ignacio, which is like the Saint-Tropez. So it's done in a very, if you like, forward-thinking way of the most committed to sustainability. We're the first winery in the world to be 100% LEED certified. And we work, to express the place. It's a new terroir that is, the vision is for Alberto Antonini, who's like the top winemaker from Tuscany. And then one of our pillars is the experiences. So we have Francis Malman is our chef. So you experience these beautiful wines with an incredible view right next to the ocean in a place that it's like the Saint-Tropez of South America.
You don't spend $250 million on CapEx unless there's growth going on. Tell us about the business and in terms of top line growth, but it also sounds like it's also experiential that you guys have incorporated. So give us, we're Bloomberg, we love all the numbers. So give us an idea in terms of the growth that you guys have seen.
Well, we've basically gone from a place that didn't grow vines to a vineyard that has more than 1,000 little parcels, little blocks. We've gone from 0 to 60 markets. We're selling all over the world. It's become the main brand in Uruguay, but it's also the leader in the States and to Brazil, to Japan, to China, UK. And it's growing very fast. Normally,
what's fast? Is it high teens? Is it above that in terms of year over year?
I mean, 100% many years.
Wow.
Doubling the business many years in a row.
Wow.
Including COVID, and as you said, all the different cycles. Wow. We toasted to our first year with our new partners in the US with the Wine Bowl. And again, we did really well in a very tough year. But you have a level of investment that it's really projected very, very long term. We have projects for hotels. We have real estate on the beach.
Wow.
Mr. Bulgaroni has an incredible golf course designed by Phil Mickelson and Angel Cabrera, that it's a PGA Tour preferred golf course. We make our own extra virgin olive oil. So we talk about the Garzón universe.
What is the biggest revenue driver? Is it the wine or is it the real estate? Dare I ask if it's even the olive oil?
Yeah, right. The first one was the olive oil, the extra virgin olive oil, and it's won like the best extra virgin olive oil in the world a couple of times. The wines are what's driving the revenue, and it's not just selling wine as a product; it's also the experiences. So we have 50,000 visitors a year, and this is in the middle of nowhere, as you just mentioned, Uruguay.
Yeah,
and it's all very high income and net worth people. It goes from 20,000 people living there in Punta del Este and Garzón to 2 million tourists around New Year's.
It's a lot.
And a lot of them are celebrities like Clooney or Gwyneth Paltrow or Messi or
Stenovec
or
Massar.
I was just going to say, that's kind of our crew, Carol.
Well, I'm here to invite you. You have to corroborate the story, right?
We only have, unfortunately, about a minute and a half or so left. You did bring in some bottles of wine, and tell us about what you brought. I don't want to mispronounce Balasto, Tanat, Albarino.
Albarino. We'll start with the white wine.
Yeah.
This is Albarino. We are the main grower of Albarino in the Americas. It's the white grape variety, like the queen of Spain.
Yeah.
We have the same kind of granite and Atlantic Ocean influence, similar to Galicia. And this is actually our best-selling wine in the U.S. Perfect for summer or the end of the spring, if you like. Top 100 Wine Spectator. So an awesome value. This is like a $22 retail.
That's great.
So there's a beautiful opportunity there.
That was Christian Wiley, Bodega Garzón's managing director.
And that wraps up the weekend edition of Bloomberg Businessweek from Bloomberg Radio. Thank you so much for joining us.
Be sure to tune in to Bloomberg Businessweek Daily, Monday through Friday, starting at 2 p.m. Wall Street time on Bloomberg TV, Bloomberg Radio, and on Sirius XM Channel 121. You can also listen to us on Apple CarPlay and Android Auto, free in the Apple App Store or on Google Play.
You can also watch our daily broadcast on YouTube. Just search Bloomberg Podcasts. And we're simulcast on Bloomberg Originals, available at Bloomberg.com/originals, and streaming platforms including Roku, Amazon Fire TV, Samsung TV Plus, and more.
Find our Bloomberg Businessweek Daily podcast at Bloomberg.com, Apple, or wherever you get your podcasts. And the latest edition of the magazine is available on newsstands now at Bloomberg.com and always on the Bloomberg Terminal. I'm Tim Stenovec.
And I'm Carol Massar. Have a good and safe weekend, everyone. Do stay with us. Today's top stories and global business headlines are coming up right now.